Hello and welcome to the practical hints and tips for the emerging manager. Honoured to be joined today by two very esteemed colleagues. Let's start with Mr. Walter Reich. I'm going to read his bio out that he's obviously put together so you can judge it purely on his beautiful prose. A chartered accountant by trade, worked for over 25 years in the offshore fund despite his youthful good looks. Has actually been in the BVI itself since 2006, having previously worked in London in a variety of capacities at the Lionheart hedge fund group, who had at one point over 900 million AUM. I believe his roles included CFO, compliance officer, marketing coordinator, and member of their management committee. So really experienced. And prior to that, also worked for KPMG, also worked for Citco. And so has truly experienced many aspects of this industry and has a great deal of wealth and knowledge to pass on. To facilitate all that he does, he formed a fantastic organization called Tovel Investments and Tovel Consulting, and now provides really useful services to people wanting to interact with the BVI and form fund structures and fund managers here in the beautiful islands. Walter, welcome.
Thank you very much, Phil, for that wonderful introduction. If I may, I might add that I actually arrived in a beautiful BVI back in 1995, actually.
Yeah, I wasn't going to give your entire plot history, but I'd say your background is incredible, and without being too modest, because you will be too modest, you know, Walter has been a fundamental part of building up the funds industry right from the get-go in the BVI, and should take a great deal of credit for how successful it's been. And then we've got Christian Thompson. Christian, again, has over 25 years experience in investment management, previously an executive at Man Group, where he was there from 2002 through to 2012, where he oversaw performance, risk and operations, and worked with over 100 emerging managers. In 2012, he co-founded Brook Bay Capital, where he's currently principal, as well as co-CIO, and he manages 2 Jersey, as well as 3 BVI domiciled funds. And then in 2019, just because he didn't have anything else to do, he also founded Mount Sage Advisors, which is an investment consultancy and C-suite outsourcing business based in the BVI. Christian, welcome as well.
Thank you, Phil.
No hidden past in the 90s being in the BVI?
No, nowhere near as much as part of the furniture here as well, but much more recent addition.
Fantastic. Well, what we want to do here today, we've got an awful lot to get through in only our half an hour, so I will jump straight into it. What we're trying to do is really help everyone out there that's trying to get going. All of those questions that you guys have both dealt with yourselves as part of sort of the internal infrastructure, but also then as providers to people that are trying to get going, and really pass on that wisdom as quickly and as efficiently as we can in the 30 minutes we have available to us. Where I sort of wanted to start with someone getting going was the actual investment management company itself. So you've got an idea, you want to get launched, you know you need a fund structure, you know you need investors, you know you need capital and everything else, but fundamentally your own internal infrastructure, what should you be thinking about? Christian, kind of over to you on that one.
Thanks, Phil. Yeah, so obviously, you know, you're sitting here thinking about this because you've already got together the construct of your business. But you know, there's a couple of key points I think that is worth considering up front, you know, especially the legal construct, you know, and getting a solid legal and commercially viable LP agreement in place is something that often gets forgotten about up front when everybody's running full steam ahead to try and get a business launched. You know, that a lot of thought doesn't necessarily go into that. It's not until you need it somewhere down the line that it comes up, and I think most people would that have been through the process would admit that they didn't really put much thought to that. But it's important to get a good commercial agreement in place. Make sure all the partners are you know, on board and correctly aligned as well. You know, I think the economic alignment point, you know, not only works at the investment management company, but also with your investors and all of your partners. It's very important to understand the economic alignment and get that correctly set up. Everything that you do. I think in terms of, you know, obviously the investment team, you know, you've potentially got a couple of partners that are, you know, you've worked together or have some professional relationship together. But I think it's important at this early stage to understand your weaknesses in that space to understand, whether you're weak on the risk management side, whether you've got some gaps in there, and think about how you address that, and the messaging around that. Obviously investors don't expect day one for you to have a fully diversified investment team, but thinking about how you make decisions and how you communicate that to investors is important. And then looking at your operational infrastructure, I think, looking at again your weaknesses. Obviously as an emerging manager, you're not necessarily going to have a COO, a CFO, and a whole bunch of other operational staff, but thinking about how you address that, whether you look to do that internally by hiring inside, or look at outsourcing opportunities. But it's very easy to overlook that, and especially as you get to the documentation stage, launching funds and so forth, and if you've got a couple of traders that have never done that before, that there's a lot of pitfalls that can be that you can fall into very early on in the day by not having that operating expertise in place to get the right infrastructure in up front.
Walter, what's your take on sort of getting set up in that sense?
Yeah, it's a very good point. I think all I would add on to what Christian was saying is when I do have an emerging manager come to me and talk to me about setting up, the one thing I love about working out of the British Virgin Islands is that we do have options to talk about with respect to the investment manager. So much so that we also have the option not to even have an investment manager if that works for that particular person in the jurisdiction that they're going into. I'll give you an example, because I think sometimes examples are the best way. We had a couple of guys come down here, I think about 3 years ago. They had $500,000 to put to work. And we managed to have a chat for about 2 hours about different potential structures that they could consider. And it all came back to what Christian was talking about. What was in the background? I mean, was there going to be money coming in eventually? Was this a case of trying to build up a track record? And so we managed to talk about these things at length, and we worked out a structure that worked best for them. But the fact that we had these types of vehicles, for example, an approved manager versus a licensed manager, opened up different options, different doors for them to consider.
I can completely agree, and I think you've hit something that I probably should have clarified right from the outset. What is an emerging manager? So often all of us will be approached by people and saying, how much do I actually need to get started? And you hear about the barrier for entry, you hear about it just getting harder and harder to get launched, and I think that's something the BVI has really closely focused on. With all of the work that sort of both the FSC has done, the regulator here in the BVI, but also the work of the sort of private sector in putting together initiatives to try and make that kind of thing happen. So fantastic to hear, you help people with only 500K get off the ground, and we do see that. And so whilst we've got the institutional fund managers running many billions through BVI fund structures, we do have ways to just people to get them up and running, and I think that's a fantastic part of our offering.
Yeah, I mean, for them, the key objective was to build up a track record, to build up a strategy that they could market. And it's interesting to note that particular client is still here in the BVI, and they have over $50 million in AUM at present. So it works.
It's that classic chicken and egg, right? You sit there, and Christian, you've done this a million times yourself. You sit there in front of an investor, and an investor says, right, I really like what you guys are doing. If only you had a track record, I'd give you $50 million. And you kind of go, well, if you give me $50 million, I will get a track record, and then we can prove it. But Christian, how have you dealt with that practically? You've done a million of these pitches.
Yeah, it's very tricky, and it really comes down to your growth strategy in terms of how you're targeting which investor base you're targeting. Are you looking at raising money from friends and family and your professional network to get off the ground? Or are you looking to go out and build fairly quickly, and as a result, potentially give up some of your management company to talk to seeders and so forth. It's a really tricky one that there's no way of replacing track record. Unfortunately, you can come up with really interesting ways of trying to demonstrate your unique selling your USP of your investment strategy. You can come up with modeled numbers and back testing and so forth, depending on your strategy, obviously. But fundamentally, your track record is going to be pretty important, and thinking about how you can port that from previous roles and so forth. Whether you've got something that can be ported across is obviously important in terms of trying to build that trust with investors. So yeah, it's a difficult one. Obviously any numbers you can put around if you're looking at equity strategies and so forth, if you can demonstrate alpha or low vol numbers or whatever it might be, depending on what investment strategy you're targeting, then really trying to come up with as much as you can to try and build a picture of trust for an investor, because they're coming in cold to most meetings, and they don't know you. So you've got to build that trust, and obviously track record is a big part of that. But if you don't have a long track record, then you've got to really try and identify other ways of building that trust.
Absolutely agree. I mean, then when it comes on to sort of choosing your jurisdiction for your fund vehicle, all of us have worked with a wide variety of jurisdictions, and we're certainly none of us are here are going to say that there's only one you should ever choose. But declaring all of our bias immediately up front, we all sit on the sort of executive committee of the BVI Funds Association. So looking at the BVI, Walter, and when you've had those clients land and successfully get launched, why have you found that they've chosen the BVI? What have they been attracted to, and what has made that a success for them?
Yeah, I mean, it's a good question. I mean, obviously the BVI is one of the big choices out there for setting up a fund. There's no doubt about that. I think one of the main things that the people that I speak to anyways, they've had either a great referral from somebody that they know, or they've done their own due diligence and they've realized that the BVI is a much more cost-effective place to actually set up, especially for an emerging manager. Maybe for somebody that's coming in with 500 million, all set up, ready to go, he might have more options available to him. But definitely for an emerging manager, I think the BVI provides options that are really geared towards that kind of structure, that kind of setup. We have administrators based out of the BVI, we have auditors, but there's more flexibility. For example, on the audit side, if you needed an audit for your fund, it doesn't have to be necessarily an auditor out of the BVI. You have an option to go and pick one out of the jurisdiction, for example, that you're domiciled in. So it just, from getting quotes to having options available to you, there's more available, which at the outset might be beneficial. So that's predominantly where we're kind of geared to. Obviously, you don't want to go to a jurisdiction where, it might have a bad reputation in the market. You might be able to go out there and have a jurisdiction that, you could set up with no regulation, but that's definitely not what you want to do. I think the BVI has found that sweet spot where it really works for an emerging manager in that respect.
I get that. I mean, to sort of address the absolutely giant elephant in the room. I mean, Christian, you were making the decision as to where to domicile. The Cayman Islands is the well-trodden path. It's got 70% of the world's offshore fund girls. Everyone knows it, and you'll hear all the time people say, "Well, what if I go to an investor meeting? What if they say, why BVI? Why have you chosen that as compared to Cayman? You made the decision, to go in the direction of BVI. What decided it for you?"
Yeah, I think it comes back to your target investor base, and if you're looking to launch, if you're looking to grow to a multi-billion-dollar long-short equity fund where you're targeting institutional investors, then they're going to want to see. They're probably going to want to stick to the bigger, European jurisdictions like Luxembourg and Ireland and so forth. But the reality of most emerging managers is they're looking to build a track record and a smaller fund and through organic growth. And most investors will understand that. They'll understand that they're looking for a regulatory environment that protects their interests, but allows investment managers to do so in a more cost-effective manner by not creating infrastructure that is unnecessary to them as an investor. And I think that the BVI really strikes the right chord there in terms of not requiring a huge bunch of red tape that doesn't benefit the investor. They're very focused on the manager and the investor's rights, but not doing it at the detriment of adding huge amounts of overhead that is not beneficial for the investor. So I think it really comes down to your investor base and deciding what structure is relevant for that investor base. And if you're looking to target institutions, probably your bigger onshore type jurisdictions may be more beneficial. If you're looking to get into that big echelon, you've got the funding to do that. But for 98% of us, we don't have that, and we've got to get through the seeding phase of getting to those types of conversations, and the BVI is a great way of doing that.
I mean, moving on to then sort of your strategy and your marketing and cap raising around that. I mean, Christian, you have worn these shoes, still wear these shoes to the day. How have you done that? What did you think about right from the outset? When you were literally getting going, when you formed Brook Bay, what do you do now? How has that evolved, and how, I guess, is that changing also with everything that's gone on through COVID and everything else? Fascinated to hear how you found the Zoom world of pitching as compared to the pressing flesh.
Yeah, it's a really good point, and it is really difficult to build investor trust when you're coming in cold on Zoom. There is definitely somewhat of a handicap there compared to the old-fashioned way of meeting and greeting. So that definitely is a consideration. People are still investing though, and doing it through those forms. So it's not to say that don't try it, but it certainly has some additional challenges, and I think it really comes back to, how do I build trust with that investor? How do I build a relationship? And obviously, if you've already got relationships in place with those people, then it's not such a factor at all. And in fact, in some ways, the Zoom phenomenon means that we speak more and actually develop more of a contact based relationship, and they may be limited by their existing relationship base to make their investment. So there are some angles where it's actually working out slightly positively, and others that not so much. So obviously that needs to be factored in, and hopefully we're moving out of that and it's not becoming such a problem. But certainly getting the right message from a cap raising perspective is front and center. Obviously all the other things that we're discussing today, the management company construct and the fund structure and so forth is all secondary, unfortunately, to the reality of going raising money. Now that may be put to one side if you're only looking at prop money. If you're only looking at managing your own money and so forth, and setting up a track record, then that's obviously not a factor to consider presently. But obviously, somewhere down the line, no doubt you will get to that point. And forming that strategy is so critical. As I've said several times already, building trust with the investor, making your product, your investment strategy a unique pitch. And it doesn't matter how good your investment team is, how good your investment strategy is, if you don't manage that message and get that message across, especially the more complicated the investment strategy, the more difficult it is to make sure you break it down to an understandable level for an end investor. Because if they don't understand what you're doing, they're never going to invest. And so, especially when you're getting into more complex, if you're looking at algorithmic trading and so forth, really trying to work out how you break that down to an understandable level for the end investor. There's no point, going in and demonstrating how smart you are if they don't understand, because they're just going to glaze over. And they might think you're a smart guy, but if they don't understand it, then they're going to move on. So really working on that message to build trust. again, looking at your target investor base, and obviously if you've got a more sophisticated investor, then you can pitch at a different level, down to the more retail investor or less sophisticated investor, which will need a different pitch. Obviously, as a core through all of this is honesty, because I think it's obviously a tendency and as you're small, to try and paper over some of your deficiencies by bending the truth. I think that is probably the worst thing that you could possibly do, because it's very easy for smart investors that you will be pitching to see through that. The moment that they see through that on one point, it taints all the rest of it. So being honest, understanding where your deficiencies are, by all means craft a sensible message around those deficiencies in terms of how you address them and try and mitigate them, but don't lie. Honesty is critical in the marketing process, and a key point to working through those deficiencies is addressing them. Part of that is the marketing deficiency in terms of, if something wasn't successful, an investor will give you direct feedback, obviously. But I think the more critical point is everybody from your side, sitting down after each investor meeting, each marketing meeting, and being critical of yourself and your team in terms of how do we do things better. What didn't go well, what did go well, and refine your pitch as a result.
Yeah, if I can just throw in a couple of points on that as well that I've seen over the years. Obviously, just focused on the emerging manager is in some cases they may have a seed investor in the background who is considering putting some money to work with them, and in some cases will negotiate maybe taking a piece of the investment manager, and that works in certain cases. But what I try and advise where possible is to actually create a founder share class within the fund that kind of motivates people to move a little bit quicker into actually seeding the fund. Because sometimes you can start trading and it's, you'll send out your commentaries to try and explain what you're doing, how you've created alpha, that sort of thing. But it's getting that investor, that potential investor, to actually complete a subscription document and mail it in. I mean, that's always the hardest part. And it's kind of like what you said, Phil, earlier about the chicken and the egg. I always say, like to emerging managers is, if you can get to 1 million, you'll get onto some more radar screens. If you can get up to 5 million, even more, 10 million, and so on. So it's really important, critical to get that mass. And so it's, how do you do it? And I find that founder share class where you're actually giving up some fees is important. Whether it, if let's say you're going with 2 and 20, but the founder share class, is 1 and 10, for example, I think it's worth consideration. Again, depending on, how many people are in your circle of potential investors. But then always putting, laying down a marker as to when that founder share class will actually close, because you want those guys to jump in at some point. And whether it's a year down the line, 15 months down the line, that sort of thing. So that I find is an important part of the equation to consider. Back in the good old days, people used to set up rebate agreements to try and achieve this, but that seems to be going away more and more now. People want transparency. They want all the investors to know, what fees are being given to what groups and why.
Yeah, I completely agree, Walter. I think that's a really critical point to get to the critical mass and understanding what your growth strategy is to get to that point. Your break-even point might be, 5 million. It might be, 20, 50 million, depending on, your infrastructure. But understanding how you get there is critical, and understanding what you need to give up to get there. But certainly, getting there as quickly as you can is ultra important. But I would also add in that we haven't really touched on is that skin in the game is imperative to investors as well. So they will want to see that, if you spun out of an investment bank, you spun out of a big hedge fund, a big asset manager, whatever it is, that they will expect you to have a significant part of your liquid wealth invested in the fund yourself, because without that, they say, well, if you're not investing in it, why should I? So working out, if you don't have a significant amount to, whatever significant is to your fund will be different from fund to fund, but I think working on how you can do that is important, because it will be, one of the most important questions that an investor will ask you in a marketing call.
Yeah,
I absolutely agree. Sorry, go on, Walter.
No, I was gonna say, just to add on to what Christian was saying there, and also considering possibly locking in some of that initial skin in the game capital, whether it's for 2 or 3 years, that will give people that confidence that you mean to have some longevity in your strategy.
Yeah, I agree. We haven't got time to touch on it, sadly, but also you've both loosely got around whether you give away sort of equity as well in your management vehicle. Obviously, that's a very hot topic. I have a bunch of emerging managers at the moment, who are seemingly very, very quick and willing to sort of give away equity very quickly, and I'm kind of giving a hold back. That's possibly one of the last things you want to do, but obviously we can touch on that. We are sadly running out of time, so I just wanted to just deal with 2 quick points. The first one is tax, which no one really wants to talk about, but let's address it very quickly. I think there is a slight misconception that you can just come to the BVI, get yourself an offshore structure. You don't need to worry about tax. Everything's fine, and away you go. Clearly, tax is very important, and the two careful areas you need to give it the most consideration are, firstly, to your investors. Where are your investors going to be based? What type of vehicle is it in their best interest to invest into, and make it as hospitable an offering as you can. And that goes with all of the great stuff that sort of Christian was saying about your message. Also, knowing that you've thought about them. This is why we have this structure. This is in the best interest for you. This works for you is really important. And that comes down a lot to where they might be based. And then also making sure that when you're taking fees out, however you're taking fees through your management vehicle or otherwise, that again, you've thought about the tax optimization for when you take that money then out of your management vehicle, and making sure that it's properly structured, and talking to an international tax structuring specialist around that is absolutely critical. Final point before we disappear and pass on to the next group. I mean, we've talked about how well the BVI manages itself to sort of meet all the international standards, but also try and stay as light of red tape as it can. But fundamentally, we all agree that good corporate governance, AML, compliance, all of that is still critical to the industry, and it's so important you get it right. Walter, you do this on a daily basis, an hourly basis. What is it that you see is crucially important they understand right from the start? What should they be looking to evolve towards, and how do they work with someone like you to make sure that all functions?
Yeah, I mean, it's probably the most critical thing these days. I think that it's important, and it kind of goes to what Christian was saying earlier, just about honesty and that sort of thing. You definitely want to get that message across. And how do you do that? Number one, you make sure that you have an independent director, somebody who's looking out for the interests of the shareholders of the fund, and not a board of directors that are just representative of the investment manager. I think that's critical. Somebody that's going to really give you critical feedback as to how to set up the fund, how to get the counterparties all working together. Probably number one thing to consider. Then I would go that the second most important thing is the administrator. I always look at the administrator as the gatekeeper, somebody who's watching that the money that's coming into the fund is coming in from good, clean sources. They do a review, AML, KYC, all that sort of thing. But equally, on a redemption, they're doing the exact same thing. So that's where the gatekeeper concept comes through. And in addition to that, we want to make sure that the investment manager is not the one with the keys to the door. So whether the investment manager is a signatory on that bank account, a joint signatory, or we give the keys completely to the administrator, where they can receive that money. They're the ones that decide whether that money can go into the trading account and when. and conversely, when it goes from the trading account back to the redemption account so that it can be paid to an investor. So, just because we're kind of low on time, I can't really go into too much more than that, but I just want to leave you with those key points.
And Christian, from your perspective, I mean, you've obviously come into sort of offering some of these services yourself. What do you see as the evolution of this space? Why do you see that this part is going to be so important to the industry?
I think it comes back to our trust point, and as compliance continues to tighten across all of the offshore jurisdictions, and the EU and others look to tighten it further. I think it becomes important that you can demonstrate that your compliance ethos is strong, that it's done in a cost-effective on a cost-effective basis, but you do have that control. You do have good corporate governance, and I think as much as anything, if you can demonstrate that you've got a strong, experienced and appropriately skilled independent board that is going to protect the investors' interests, then it goes a long way to developing trust, because you're demonstrating that you put it in the hands of appropriately skilled people to protect their interests, and therefore it just builds the trust circle, so to speak. I think it's always been important to a lot of investors, but I think it's often been a point that has been overlooked. And I think obviously 2008 was a great example of where the trust was breached in several cases, and I think ever since then it's become a much more important point, and true independence and appropriate skills of directors and others in fiduciary responsibility is really important to investors. And obviously, therefore, it should be important to investment managers as well.
Of course, it is. They interests are aligned on that front. Yeah. No. Well, thank you ever so much to both of you for joining us. That's really useful. There are a million other things we could touch on, and obviously expand out those conversations. But really appreciate your time, and we'll hand over to the next session. Thank you.